Welcome to FinTech API Power-Ups, a concise lecture on building and using APIs in financial services. In this presentation, we'll explore how APIs transform banking, enable new revenue lines, and require tight integration between developers, security, and operations. Listen for practical patterns, deployment tactics, and real-world examples that help banks and fintechs unlock scalable value while staying compliant and secure. Traditional banking centered on deposits and loans, which limited profit streams and slowed balance sheet growth. The API-driven platform economy flips that model by exposing core services like payments, KYC, and FX as callable APIs, enabling fintech partners to piggyback on regulated rails and produce per-call fees and new revenue. The result is faster scaling, diverse revenue streams, and a platform that grows beyond the old balance sheet constraints. Developers are the new customers, so clear documentation, sandbox playgrounds, and highly available APIs become business levers. When developers can quickly select APIs, test in a stable environment, and integrate reliably, they drive flows into capital markets, neobanks, insurers, and ultimately unlock billion-dollar value streams by embedding financial services into broader products and platforms. A structured API development strategy starts with open API-driven design and automatic SDK generation to enable parallel work. Internal and partner teams can choose gRPC for high-frequency streams or REST for general services, while a secured API gateway enforces rate limits, audit trails, and mutual TLS. This approach supports simultaneous coding, predictable contracts, and strong enforcement for a secure fintech ecosystem. API virtualization lets front-end teams build UIs immediately against simulated endpoints, while back-end teams develop logic in parallel, reducing cross-team wait time from weeks to hours. Virtual endpoints plus traffic recording produce realistic test data and automated testing, which lowers integration defects significantly and speeds time to market by enabling early UI work and continuous integration without full back-end readiness. Shift-left security combines static scanners, dynamic fuzzing, and SBOMs early in the pipeline to catch issues before deployment. Pairing these practices with OIDC tokens for auth and hardware security modules for key management creates defense in depth. Together, they provide zero-trust protection and ensure that even in a breach scenario, containers yield zero usable card data, preserving integrity and compliance. PSD2 and open banking turn customer data from a locked asset into portable resources. With consumer consent, banks expose account, transaction, and balance feeds to AISPs in real time, enabling personal finance dashboards and instant updates like spend categorization within seconds of a card swipe. This transformation empowers consumers and fuels new services that rely on continuous, consented data access. PIS APIs offer a faster, cheaper alternative to traditional card rails by enabling direct initiation, instant verification, and near-instant settlement. This route reduces or eliminates interchange fees, cuts chargeback risk, and speeds settlement from days to minutes. The net effect is substantial cost efficiency and a structural improvement in payment flows, with open banking routes often delivering roughly 30% lower checkout costs. Bank APIs evolve visible services into invisible utilities embedded in super apps and platform ecosystems. By exposing open banking and data access, banks enable gig platforms, crypto on-ramps, and BNPL services to integrate seamlessly, creating positive feedback loops. Over time, incumbents become regulated infrastructure providers, benefiting from increased data, liquidity, and network effects, while enabling third-party innovation. Platform integrations bring clear business impact when APIs are embedded in consumer experiences. Ride-hailing and gaming apps can offer one-click funding and instant payouts via REST calls, while SaaS platforms keep users inside their UI to avoid drop-offs. These integrations improve conversion by up to 22% and create new revenue lines from interchange, share, and float on stored value, increasing engagement and monetization. Real-time underwriting and BNPL settlement rely on fast, integrated e-commerce APIs. Stage 1 ingests cart value, shipping address, and open banking cash flow. Stage 2 runs an underwriting API that returns a credit decision in roughly 400 milliseconds, and Stage 3 completes approval and merchant settlement. That tight flow enables instant funding, smooth checkout experiences, and secure merchant conversions behind the API. Micro-insurance APIs price risk contextually per transaction by invoking dynamic pricing algorithms at the moment of purchase. Platforms like travel, electronics, and gig marketplaces can offer tiny, on-the-spot covers. Examples include flight delay, protection, or handset device insurance, turning annual policies into contextual SKUs, boosting average order value, and requiring no inventory while providing incremental revenue. Blue-green deployment, combined with real-time anomaly detection, reduces deployment risk by routing a controlled fraction of traffic to new ledger code while comparing outputs across versions. If the comparison engine finds mismatches, the system auto-rolls back instantly. Blast radius limitation further caps financial impact, so rounding or logic errors cost cents instead of millions, enabling safe, continuous delivery in finance. API versioning balances stability and innovation by freezing regulated contracts via URL versioning, while allowing feature negotiation through headers. A sunset and deprecation strategy with 6-month notice ensures auditors can trace historical calls, while parallel versioning supports non-breaking feature rollouts. This approach preserves predictable behavior for compliance-sensitive clients, while enabling iterative improvements for modern apps. Observability relies on structured logs, distributed tracing, and metrics to resolve faults rapidly. Emitting trace IDs across API gateway and microservices links events end-to-end, while P99 latency monitoring surfaces slow paths. Pairing metrics with trace replay lets teams locate the exact failing call chain and isolate the root cause, often allowing resolution within minutes and improving operational confidence. Credit decision APIs ingest real-time signals like cash flow volatility and e-commerce seasonality into nightly retrained machine learning pipelines fed with fresh open banking data. The result is measurable performance gains, lower default rates, and auditable transparency through explainable reason codes, giving regulators the traceable rationale they need, while improving credit accuracy and reducing risk for lenders and neobanks. Stablecoin treasury APIs let neobanks route idle fiat into audited DeFi lending pools with atomic swaps and smart contract risk limits, aiming to generate yields around 4%. On-chain proofs and public auditability satisfy compliance teams by exposing transparent evidence beyond closed ledgers, while firewalls and limit mechanisms reduce smart contract exposure to ensure treasury operations remain auditable and controlled. Quantum advances threaten classical RSA-based signatures, so a pragmatic defense uses dual-stack negotiation to pilot post-quantum ciphers alongside classical TLS. Client and gateway can negotiate lattice-based key exchange in parallel with existing ciphers, allowing payment rails to maintain confidentiality even if RSA becomes breakable, and providing a future-proof migration path to protect long-term payments and sensitive financial data.